please give a warm Georgia Tech welcome to our guest, Rick Lane.
Thanks, Jackson. Appreciate it. Can everybody hear me okay? I want to share with you a story today. It's very much still a story that's happening. As much as I at TT would like it to be behind us, it's one that we're still living through and really have been living through for the last 5 or 6 years. And it's really a story about tech disruption and specifically the Innovators Dilemma and how my firm has really been trying to circumvent the Innovators Dilemma over the last 5 years. Before I get started though, just a quick show of hands. Who in the room is an undergrad student? Okay, and then who's a graduate student here? Okay, so I'd say it's skewed more towards graduate students. Last question, I promise. Who knows what the Innovators Dilemma is? Okay, wow, I'm actually surprised. I didn't go to business, what's that? Okay, that's all I did too. But I guess I assumed that was sort of business school 101 these days, although I think maybe that's falling out of vogue these days. But I'm going to talk a little bit about the Innovators Dilemma, and I'm actually glad I didn't see a lot of hands there because I only learned about it 5 or 6 years ago, and to me it was a pretty eye-opening idea applied to how businesses that really do everything right can still nevertheless be disrupted overnight. So I'm going to talk a little bit about that story. Before I do that though, I realize this is Georgia Tech after all, and I think I need to establish a little geek cred up here for you guys to take me seriously. And while I am the CEO of TT, I'm also still one of the top code contributors there, so I do try to straddle the two sides of the world a bit. As Jackson mentioned, I was a Georgia Tech computer science major. I graduated in 2003. We were still sort of in the shadow of 9/11 then, and almost every job interview I went on upon graduating was in the defense-related industry in some capacity. I think just about every on-campus interview I had was a defense contractor, so Raytheon, Northrop Grumman, Harris Corporation, defense consulting firms. And it was in my senior year, still hadn't figured out what I wanted to do. I knew I didn't really want to be writing database code in a windowless room for the rest of my career. I wanted to still be technical and write code, but I also wanted there to be kind of a social aspect to it as well. So I was still trying to figure out what I wanted to do. And I had a really, really good friend of mine who's still my best friend to this day. He and I, we were neighbors at the time here right next to, we actually lived at the Post Biltmore, so just around the corner here. We were playing Halo super late one night, and he was telling me about this professor he had. He was an international affairs graduate student at the time, my buddy was. Basically the opposite end of the spectrum from a computer science major. Nevertheless, we were still really good friends. He had this professor who for decades had been incubating this idea on Germany's World War I battle plan, which was called the Schlieffen Plan. And this professor, Dr. Michael Salomon, whose name's on the slide there, had some of these theories around if certain things had happened slightly differently, the outcome of the war could have been drastically different. And I was looking for an easy A, given that it was my senior year, so I said to my buddy Nate, I was like, hey, why don't we pitch to your professor, who I'd never met, that we'll build a computer model to apply some statistical rigor to his ideas, let him do some of these what-if scenarios on this battle. To me, I was chalking this up as this will be a piece of cake. I'm just going to build this little model and it'll be a super easy A. Professor jumped at the chance and said, absolutely guys, dive head first, go ahead and do it. And so what really kind of started as this way for me to get out of doing a lot of work my senior year became this passion project for my buddy Nate and I. I mean, honestly, we probably spent 2 or 3 times as much time on this project as anything else I had done in my tenure at Georgia Tech. And for those of you who go to school here, you know that's saying a lot. This really became something we invested ourselves to. And it was great for lots of reasons. And this is sort of maybe a common thread throughout my talk today, which is it forced us to learn how to take completely different disciplines, completely different ways of approaching problems. I knew nothing about history. I knew nothing, nor did I want to know anything about doing really quality research, the type of research that you would need to input into a computer model like this. He knew nothing about programming and wanted to know nothing about that. And he knew nothing about the limitations and the constraints of what we could be building in this computer model. But we were still nevertheless tackling the same problem. And those lessons learned really turned into something special. In fact, the last week of school, we still didn't know what we were going to do for a living. And this professor, Dr. Salomon, would bring folks from the industry meaning defense consulting, wargaming, combat modeling, modeling and simulation, And he brought them in, as he does every year, and he said, hey, you guys got to come check out what Rick and Nate built. And they looked at the system that we built, and they gave us jobs on the spot, and we took them on the spot because we were just so passionate about this. So Nate and I spent a couple years in DC doing this professionally and doing this for a living. But more importantly than that, he and I realized we had done something special there and really did something that we wouldn't have really had an opportunity to do in our day-to-day coursework in international affairs or CS. And with the help of my friend's family's foundation, we were able to come up with seed money to actually turn this into a real class. Half international affairs students at the time, half computer science and engineering students. They literally took the Java platform that we built as a starting point and did all the things that we wanted to do that we ran out of time to do. They applied it to different combat scenarios, different wars altogether. They enhanced the model where we wanted to enhance it. And this will be the 15th year that this class is going on, and it really has gained its own momentum and head of steam. And now it has evolved. They're no longer using that initial Java core that we built, but it's really turned into something else. So this is just a little plug for if anything I just described sounds at all interesting to you. Dr. Salomon, he's kind of the godfather of this and the founder of this. Dr. Mariel Borowitz is really the one who runs this from a day-to-day perspective now. She has been doing this for a few years. Fair warning, it's a really tough class to get into, but if any of this sounds interesting, you ought to look it up because it really will, I think, teach some pretty important lessons, regardless of what business you go into, that we still to this day use. And in fact, we're using today a lot of those same lessons learned in my current job in capital markets. So all of that said, that sounds really interesting, and it was, but wargaming is, at least doing it day in and day out for the government, is not as sexy as Hollywood makes it seem, especially in the movie Wargaming. And so after a few years of doing this, I was looking for something different. It just so happens that I have a cousin, older cousin, who 10 years ago, 12 years ago, I knew he did something in trading. I didn't even know what trading was. I knew he was an interest rate futures trader, but I didn't know what any of that meant. We were at Thanksgiving dinner one year, and he said, hey, I know you're looking for something new. I know you're a good programmer. I'm seeing a change in my industry, trading, derivatives trading, that I'm worried about, that I want you to come help me get in front of. And that change was the advent and the disruption of technology to his industry. And just one quick other plug for the business school that you guys are now privileged to be a part of. When I graduated in 2003, I had almost zero exposure to capital markets, to trading, to market structure. I knew nothing about finance. And that's really because there wasn't a lot of exposure to it here at Georgia Tech. I know now firsthand that Scheller really does provide a lot of opportunity, whether it's financial engineering, whether it's markets, that really would give you a leg up if this industry is interesting to you. I wish I would have had it. In the early days, applying algorithmic trading to these markets was shooting fish in a barrel. Had I been there a few years earlier, I think I probably wouldn't have flown coach down to Atlanta here to see you all, because it really was fundamentally, there's a massive advantage to being first to market here. But anyway, it's just a plug to take advantage of those opportunities that Scheller makes available to you. But anyway, just to highlight the speed with which the trading industry was being disrupted by technology. December of 2005, my cousin said, hey, before you make a decision, come out to Chicago. Chicago is sort of the epicenter of the futures trading world. Come look at what we do, and you can make a decision then. So I flew out to Chicago. I was still living in DC. And I remember going down to the Chicago Mercantile Exchange, to the trading floor. And I'm telling you, this was the most intense, overwhelming, completely overwhelming and intimidating experience of my professional career at that point. It was just thousands of people in the largest interior space I had ever seen before in my life. In all these different pits scattered around, thousands of people shoulder to shoulder, screaming at each other, throwing paper in the air, sort of pushing each other out of the way. And I was like a deer in headlights. I couldn't believe this was actually a thing that happened in the world, and even more so that they were able to really, this was like the engine and the heart and soul of capital markets and finance in our country and in the world. It just blew me away. So I took him up on the offer. I flew out in the spring of 2006, just a couple months later, And I remember my first week, I went back down to the floor after I started, and you could hear a pin drop down there in the pits. Not all of them. Some of them were still lively and still raucous, but it was a night and day change, and really just a matter of 4 or 5 months. The amount with which electronic trading had supplanted open outcry trading. So it really was an incredible pace of change and disruption. So I came out to Chicago. I didn't know the first thing about trading. I didn't know what a bid and an offer were. First 6 months was me just trying to not sound like an idiot and look like an idiot in this job, and I was basically a clerk. So I was in the office before 5 a.m., and I was used to waking up at 10 a.m. I was the first one there. I was trying to make sense of all of this. It was a really, really tough environment. But the thing, once I sort of started to learn the ropes and could really apply and add value to this business, and we could really start to build automated trading strategies that were making money, it got worse because there was this sort of communication barrier. I was the only engineer. All the other traders really didn't understand the process of building software and software quality and things like that. And so the way that my typical day, I was the only one in the office because everyone else was down on the floor at the exchange. We had an intercom system where they could hear me all day, I could hear them all day. I was upstairs running all of our algos. They were downstairs doing the crazy open outcry trading. I could watch monitors, let them know when news events happened, or let them know when I saw certain things. They could yell up to me when opportunities arose where we could build an algo on the fly and run it and try to capitalize on one of these fleeting opportunities. That might have been a news event that occurred when Hurricane Katrina was stronger than people predicted. That knocked the market out of whack for weeks. But usually it was shorter, fleeting opportunities. A large order would come into the market, and they'd say, Rick, we need you to build an algo that does X, Y, and Z. And then if this happens, turn around and do ABC. But if this happens, then the algo should shut itself down. And we need it running in the next 20 minutes because this market imbalance is going to be gone in 20 minutes. So I'd frantically try to write this up without putting in an infinite loop or some other bug that would literally bring down the economy of our. I mean, and that's not hyperbole. Does anyone know what this chart is? Any hands? That's the flash crash, right? Flash crash was essentially the catalyst was a not very sophisticated algo. In fact, it was an algo running on a trader's machine from London trading Chicago markets. So it was not highly sophisticated. And these were in the 2005, 2006, 2007 days, way before exchanges had ubiquitous kill switches, before best practices were sort of arrived upon for how you should participate in ultra-low latency trading and algorithmic trading. Honestly, one infinite loop could have not just brought down the products in the market that we were trading, it could have had wide-reaching impact across equity markets, across FX markets, and I was so afraid of that. And I won't tell the story now, but afterwards, if this is interesting to you, there's one memory that I still to this day wake up in cold sweats occasionally. It was involved in an infinite loop, and it honestly, it could have been hundreds of millions of dollars of a loser of a stupid little bug. So it was an untenable situation for me. I hated every minute of it. Something had to change, and trust me, I considered leaving and finding a more stress-free career many days in these first couple of years. But the one thing that allowed me to keep my sanity was I realized whenever these traders would call up and say, Rick, I need you to do something that does X, Y, and Z, X, Y, and Z, they were always kind of the same components. So I need you to make a market in this product based on the last traded price over here. And then when you get filled on an order on this market, I want you to turn around, I want you to submit a hedge order. That hedge order should be based on some combination of other contract prices. I realized all these building blocks themselves weren't changing. It was really just how we were piecing them together. So for my own sanity, I started to build these little modules, these little bits of code. And when they would yell up to me, really my job at that point was just building the glue to string these things together. I knew that modules themselves were well tested. They weren't going to blow up in my face. I was able to really minimize the risk of writing bad code. But it was still an incredibly stressful situation, but I at least got it to the point where I could manage it from a day-to-day basis. But it still wasn't enough, because what I realized was for this to really become something where they could cut me out of the picture, and I don't know if you see the theme here, but I was really just trying to get myself fired to have a new job. I knew there was an opportunity to take those same building blocks and literally just build a graphical interface around them. And these blocks were blocks that any trader, regardless of their technical aptitude or experience from a computer perspective, knew. They were in the trader's vernacular. They understood what these blocks did. It was using their vocabulary. I can talk for hours about visual programming and how a visual programming language can be really successful and how they can fail. But suffice it to say, the really important part here was that they understood what all of these blocks did. Traders understood this. And we basically said, if you can write your algo on a napkin or on a whiteboard, just the flow chart. You don't even need to think about programming. Don't even try to think about, these are folks that Excel, they struggled with Excel formulas. But they were able to wrap their heads around the Algo Design Lab, which is what this platform was. And it was this platform that, this is now post-2008 financial crisis. So this kind of consistent theme of participants in high finance and capital markets and trading were facing diminishing margins, increased cost pressure. They were looking at cutting costs in terms of infrastructure, in terms of having large engineering teams. We knew something like this would resonate because it was all about accessibility. If you're a small individual trader who doesn't have an army of engineers on your staff, or you're even a big trading firm who has engineers, but you want to go from hours or days to implement a trading strategy to literally minutes, we knew this would really resonate. And so we decided to spin off a commercial software company in parallel to our trading business and sell this software really alongside the 800-pound gorilla in the room, which was Trading Technologies. They were by far the market leader. We knew they had a war chest of patents. We spent a lot of time and a lot of money making sure that our software, our trading platform, which was really just a subset of what TT provided from a market coverage perspective, we wanted to make sure that we weren't violating any patents or anything. So we spent a lot of time doing that. We launched at the end of 2009 this commercial trading platform. And by June of 2010, we were acquired by TT. And it didn't take very long for us to make a mark with this platform, with this technology, and for TT to really see that they could take something like this and allow it to disrupt at a far greater scale. So I talk about ADL and that path for a couple reasons. One, because it really is my entry point into trading technologies, and there's a meaningful story to be told there. But also because this is really taking those same lessons learned in wargaming, where you've got a highly complex concept, network graph theory, looking at something like a terrorist network or an asset network, and allowing someone like a two-star general who's not proficient in graph theory to be able to manipulate and interact with something highly complex and really gain insight out of it without even necessarily knowing that they're doing something highly complex. That same approach, I think, is probably one of the most fundamental ways that technology can be successful. And that's, I guess, always in the back of my mind. How can you make something that's otherwise very inaccessible to a large population very accessible? And you'll see this common thread in even what we're doing today at TT. But before I get to that, maybe a little bit more background than Jackson provided, although his summary was pretty good. So TT, who are we? We are a almost 25-year-old company who services almost exclusively the high-end, sophisticated professional trading community. Folks like my folks who sometimes fancy themselves in retirement day traders, they use online brokerage and online technology. They're not users of our technology. The learning curve would be far too steep, far too expensive to use, probably too complex to use and really get any value of. But we really cater to the biggest names on the sell side, the top banks in the world, anyone who's really managing risk or taking on risk all day, every day is kind of our target and core user base. We have, I think it's actually 14 offices now globally. We just opened a second office in India. Just under 400 employees globally. It's about half engineering. The other half is kind of, we're a 24/6 business, so follow the sun support and operations. And then about a quarter of that is external facing, so customer success, account management, and sales. 19 of the top 20 banks and brokers use our technology for their derivatives. I think we're just over 45 exchanges actually now across 20 plus countries. And again, just another slide to reiterate, the biggest blue chip names in the world entrust TT to their derivatives trading and risk management. This is a slide that sort of aims to underscore how complex and costly it is to run a platform like what we run. So the numbers there, we've got about a dozen data centers. I think we're closer to 14 now. These are data centers that are private data centers co-located with the various exchanges around the world, all in the name of latency. The numbers that you see on the long haul links that we also manage between these data centers, and it creates a full mesh, so a fully redundant mesh. Those numbers are round trip times in milliseconds. Generally speaking, with very few exceptions, these are the fastest ways and the fastest paths to get bits of data between financial centers globally. Intra-data center, so our internal latency, so the amount of time it takes for us to get a piece of market data from an exchange, process that market data, and have our response back on the wire to trade it, is measured anywhere from 20 to 25 microseconds. That's typically our latency budgets. That's 25 millionths of a second. So incredibly, incredibly fast numbers. You can't do these things cheaply, and there's a lot of fixed cost to this. And in an industry that has been under increasing pricing pressure with decreasing margins, a lot of tier 1 banks globally have started to look at ways of offsetting this fixed cost and fixed cost around infrastructure, and that really is kind of the catalyst for the changes that we're seeing and the changes that we're having to get around. But these numbers, our clients care about these numbers, and there's really no way around this, but suffice it to say, it's a really complex problem and a really costly problem to solve. I'm not quite sure if this is going to work, but let's see if I can just click on this. So everything I just talked about there was sort of the back end, the infrastructure that makes this work. The other real challenge here is the front end. So if you ever walked into a professional prop trading group and look at one of the main senior traders there, you'll see they'll have 4 monitors, some of them have 8 monitors, some of them have up to 20 monitors. Single PC, 20 monitor display. This is a 16 monitor display that we have set up in our lab, single process, single computer. It's a specialized computer. It's a custom motherboard that allows us to run 3 6-port graphics cards, so we can push up to 18 on this machine. But you can imagine these are very difficult things to pull off in the front end. And I'm showing you this now, and I can come back to this because this is also pretty relevant in terms of our ability to sidestep the Innovators Dilemma ourselves. See if I can skip out of here. Let's see. Okay, so that's the segue to the Innovators Dilemma. So, as I mentioned, ADL brought us to TT. 2010, June, we joined the firm, and I spent just under 2 years there integrating ADL into TT's flagship platform, which at the time was about 20 years old. It probably should have taken about 2 months to integrate, with another 2 to 3 months of testing and deployment and release cycle and that sort of thing. But it took almost 2 years, and when I left, it still wasn't deployed to production. And so on my way out of the door, I sat down with the then CEO, and I just complained a lot. And I said, look, if you've got the biggest names as clients in the world, they're all happy. No one's asking you to change. No one's asking you to look at other technologies. But the industry is now moving faster than you have the ability to keep up with. You've got an army of engineers here that are having to work harder and harder to eke less and less value out of the technology and value to our constituent client base. And this is a recipe for disaster. I didn't have any answers. I was just complaining. But I guess I planted a seed in his head. And when I left, I actually took a job at Google and moved to New York. And I kept in pretty close contact with the senior team back at TT. Our head of IP actually said, hey, you ought to read The Innovators Dilemma. Short book. I encourage you all to read it in this room. Clayton Christensen, I think he's a professor now at Harvard Business School. It's his theory about how really, really good companies who essentially do everything right can nevertheless fail spectacularly almost overnight. And he tries to explain why that happens and reasons for why that happens. So I read this book, and I'll get to this in a bit, but it really resonated with me that this was the dilemma that TT was, if not facing yet, was soon going to face. I'll talk a little bit about this. So I'm not going to spend a lot of time. I'm not an expert here, but I did stay at a Holiday Inn Express last night, so I'm going to try my best to sound smart here. But the Innovators Dilemma essentially tries to prescribe two kind of fundamental reasons to this theory. The first is that the immutable laws of nature from a technology perspective is that all technology and innovation follows an S-curve of value to innovation. So, in the A region here, any brand new technology essentially doesn't even have a target audience. It's so early stage that it hasn't really found something that's going to stick to even a small niche user base. If it survives long enough and very rapid iterative cycle in those early days, if it latches on to even a small niche user base, what tends to happen is you start to iterate and really start to add incremental large chunks of value to that initial niche user base, where every step along the way you're not only adding existing value, but you're really being able to branch out and provide more and more value, and subsequently grow that initial user base where it starts to snowball. And if you're lucky enough to get through step B here, what tends to happen is you get into this exponential growth part, where every new version, every new iteration of the technology that you're building, this is not just software, by the way. This is the book. He talks about the hard drive industry, and that's kind of the common thread throughout. But he also talks about farming equipment and construction equipment. If you're lucky enough to get out of step B, every new iteration adds so much tremendous value and really starts to expand that user base that you get to this point where you're essentially disrupting the incumbent user base of whatever the technology that preceded this was. But immutably, you will enter this region where every iteration starts adding less and less value, where you start to get into this diminishing return period, where it takes Herculean efforts to build new technology and add new value out of that incumbent technology that you're providing. And this is sort of the end of life of most technology. That's sort of just the first principle of the S-curve of technology. The second one is what he calls incumbent-sized deals. So what this means is any large, successful company who's established typically has large, established, grade A, tier 1 clients, and clients who have a ton of leverage, clients who add a ton of value to their business, but who essentially get to dictate product direction. They essentially get to dictate the direction that vision takes within that company, product roadmaps. It becomes very difficult to steer away from this high-value client base, what their needs are. You start to get growing and growing sales expectations, growth expectations. And because of this, as new technologies start to emerge, management teams, CEOs of these companies, they're not even making the wrong decision. They are consciously discarding these new technologies because they represent pennies on the dollar to what innovation and investment can mean to the incumbent user base. And so on the flip side, the companies who are able and free to attack these very small niche audiences and these new emerging technologies, they don't have those constraints. They're not shackled to all of that. They're able to find a customer, find the right customer, and build and iterate in those early days to where they can really start to snowball and find an audience without having to answer to these very, very high value, high demanding clients. And you can imagine now when you overlay these two concepts, you start to see where you're in this sort of danger zone, where just as the incumbent company, the established company, starts to reach its period of diminishing returns, the new technology, the next generation company, the company who hasn't been shackled to these growth constraints and these growth expectations, they've now had a 5-year head start, essentially learning how to grapple around this new technology, learning how to build a business around it. Meanwhile, it's getting more and more sophisticated as with every iteration throughout this exponential part of the S-curve here, so much to the point that it starts to reach the same level of sophistication that it can now solve the needs of the incumbent user base. Remember, down here, the incumbent user base looked at the new technology and they said, no thanks, we don't want it. It's not sophisticated enough to solve our needs. But now that suddenly changes, and almost overnight you can see what happens here, where the incumbent company now is simply not able to catch up to the emerging technologies and emerging companies. So Christensen goes on to talk about ways that companies can try to circumvent this. And he readily admits that most companies that even try to do this, they still nevertheless fail, because it's a very difficult mentality to have at an established company who's making money hand over fist and who's got really big customers who are willing to keep writing really big checks. But basically, and these won't be a surprise to you, but he basically talks about creating autonomous groups, or sometimes even entirely separate companies, and allowing those companies to operate freely from those constraints of the existing incumbent user base. Those companies, those little autonomous groups, can find their right customer. They can iterate quickly. They can fail early and often, and do so freely. They can leverage resources of the parent company, but doing so sparingly. What you don't want to do is take legacy processes that the incumbent company has, legacy technologies, and you really don't want to take legacy customers to this new autonomous group, because you don't want that to influence the way that they proceed. And the idea is that if you're able to do this successfully and compartmentalize it and really segregate that business well enough, you can stand a chance to be able to build and learn, and throughout that 5-year period where that new technology really grows in sophistication, you can give yourself a fighting chance to be the one that essentially disrupts. So I read this book, and to me this really, really resonated with what TT was facing or about to face. We had the number one product on the planet. We had the biggest names in the industry telling us how much they loved us. They were happy. They didn't want us to change. It was, on paper, everything seemed really positive. But the platform itself was taking more and more effort to add the same amount of value to that constituent user base that we had. Cost pressures were continuing to take legacy technology, infrastructure-heavy technology like this, and firms were more and more looking to shed this. We had 40 different versions of our platform in production. It was a support nightmare. We knew something was going to give, and something had to give. What I didn't want to become was the next BlackBerry. BlackBerry loyalists were loyalists until the day they weren't, and then they all went away. And we were looking to try to prevent that. We knew that, rather, what we tried to think about here was, what would we as TT be the most fearful of if a competitor emerged to our right? And if that competitor did what would we be really, really concerned about? So things like, if that competitor could have a single platform globally that they had to manage, that allowed them to operate much more freely than we could operate. If that new competitor was able to do something like offer the software as a service model to a tier 1 bank from a market access perspective. So just to give you a little anecdote, any tier 1 bank that's a client of ours, if they want access to a new market, let's say they take on a new client who wants to trade Montreal. Well, if they don't already support Montreal, in the old world, it would be about 6 months to get that bank set up, get the infrastructure installed, get the servers in place, get all the software configured the right way. After 6 months, that bank and their customers can now start to trade Montreal. That's a heck of a lot of investment and commitment to a market that maybe that bank's customer isn't even sure that Montreal is going to be profitable for them. Those days were gone, and so we thought to ourselves, if a competitor could come up and build the same level of sophistication that we could build, but offer, the same way Netflix offers month-to-month access to their technology, if a competitor could offer month-to-month access to Montreal, you want Montreal? Here, tick a box, click save, you've got Montreal. You don't like it anymore, or it's not profitable? Uncheck that box and click save, and you can walk away from it month to month. Those are the types of things that we said if that happened, we'd be dead in the water almost overnight. I didn't spend a lot of time at Google, but I spent enough time to know that they don't make any decision without really understanding the impact it has to the end user, without really understanding how the end user is using that product, whether it's search or maps or what have you. We operated on a legacy technology stack that fundamentally didn't allow us to know our end user. So we were making product decisions in a vacuum. We didn't know if someone was using a feature that we were about to remove. We would often remove something that we didn't think anyone was using, only to find out that 35% of our user base relied on it, and then we had to quickly go back and re-add it. This ability to be able to keep up with an industry that was, the pace of change was itself increasing, we knew we needed all of these tools at our disposal. And we also knew that our client base was starting to expect in professional trading the same things they expect in almost every other industry where software as a service has disrupted. So we made a bet, and this now goes back almost 6 years. and now when I think about it, it seems pretty darn scary, the bet we made. But we were basically saying that despite every tier one bank client of ours telling us, not only are we not using the cloud now, but we'll never touch the cloud. Our clients, our data is far too important to risk putting on the cloud. They were telling us, if you build a platform that touches the cloud, we're never going to use it. Professional traders who are highly sophisticated professionals, they're pros, the idea of using a web app to do their job. I've got 16 monitors here. I'm a professional trader. There's no way I'm going to pull up a website and do what I do for a living via the web. We were making the bet that these things would no longer be truthful when the technologies themselves both reached a level of sophistication where we could pull off a 16-monitor workspace, but also where the acceptance within the industry of these technologies would also culminate to where not only were banks okay using the cloud, but they were essentially all in. We knew the economics of cloud computing were too great, especially as cost pressure was continuing to drive down tier one banks. They would have no choice but to adopt the cloud. One of the bets we made was that banks would, in fact, embrace the cloud, and as you've seen over the last 2 or 3 years, they're all in. Every tier one bank client that we have now is not just using it, but truly it's transforming the way they do data storage, it's the way they do, transforming the way they do infrastructure. This one, I think, was probably one of the easier bets to make because we knew the commercial implications were so compelling. The other bet we made early on was that Google, essentially, we were trusting that in 2011, 2012, when Chrome was on version 19, and we knew full well that 2011 Chrome could not drive 16 monitors on a single PC. We were making a bet, though, that the bet Google was making, that every client-facing software in the future would be delivered via the web platform and via HTML5. We knew they were all in on that bet, and so we were sort of riding their coattails, that as they would continue to innovate in the browser rendering stack, in being able to do multi-threaded programming in the web platform, that we could sort of, as that was growing in sophistication, so too would the industry acceptance of these technologies grow. And so that video that you saw earlier, that was actually a single web app, all JavaScript, HTML5, driving millions of price updates a second across 16 monitors. And that would have never been, you could barely run a single monitor with 25 widgets in it 5 or 6 years ago. So this here is where we started, version 19 in spring of 2012, version 19 of Chrome, and I think they're at 70 now, 70 or 71. We are deeply in touch with the Chrome Canvas team. It's actually a part of, I specialize in computer graphics when I was here at Georgia Tech, so I sort of own all the rendering components of our render pipeline. So we're always sort of aware of what changes Chrome is making and figuring out ways that we can eke out a little bit more performance. But that really was the bet we made, and we're seeing it pay off now. So, as I mentioned, this is still sort of a story that we're living through, because only about 40% of our user base is migrated. We announced 2 weeks ago that we're sunsetting our legacy platform at the end of next year. So we've got 40% now. We anticipate around 45 to 50% by the end of this year, and then 100% of our user base will be on the new HTML5 software as a service platform by the end of next year. And that's telling in and of itself that we've done what we set out to do, and we've managed to grow a technology that 5 years ago was simply not ready, but we had the head cover because we had an incumbent company that was able to pay the bills, essentially, while we iterated, while we failed more times than we succeeded in those early days, and really found a niche audience that could take those early stage versions of this software as a service platform and tell us what worked, tell us what didn't work. But I think more telling than any of this now, those same tier 1 banks that 5 years ago told us we'd never touch this technology, they're not only now migrating to this new platform, but they are asking us how we can solve other problems that they have. Other parts of the trade life cycle that TT has never participated in before, but they're seeing that this technology really is head and shoulders above anything else in the market. And that, I think, from our perspective, is the most telling aspect of this. And I think that the scale of this has changed over the years, but again, I can't stress enough how important the notion of accessibility is to technology, and how, if that's the only thing that keeps you up at night, how you can make technology that's otherwise inaccessible, whether it's to a 2-star general, whether it's to a trader who's looking to compete in low latency trading, or whether it's to a tier 1 bank who is suddenly faced with the dilemma of trying to manage global infrastructure at scale under increasing pricing pressure. The ability to pull up a web browser and provide global market access to a tier 1 bank like Goldman Sachs or JP Morgan, that those are the same principles that I think I learned in those early days here at Tech, and have really served me well and served TT well throughout the years. And really, this is the last slide. We now fundamentally believe that we have a 5-year head start, that we're now that second curve on that second S curve, and that every competitor in our space really is starting to see that the industry really has begun to accept software as a service, that the high-end professional trader realizes that we can create the exact same experience on the front end that they're used to, that they don't have to be afraid of the web platform, and the industry is really ready to embrace what we've built. So that's all I've got. I don't know if there's any questions. Otherwise, we can also do one-on-one questions afterwards. So I'll repeat the question. So the question was, when we were making the bets, did we have any hedges? The answer is no. So we were talking about, we had an all-hands meeting a couple weeks ago, actually about a week and a half ago, and someone else asked the question, when are we starting the team to get on the next S curve? Because if we're now right in that exponential growth part of ours, we're going to soon be hitting the diminishing return part. And when are we, how does that work? Like, Rick, are you thinking about the next S curve? And I had to let them down that no, I'm not. But I think it really is it's something that's a continuous problem, that companies always have to have that mindset. You don't always have to spin off a skunkworks team as we did with, I think, about 12 people initially. You don't always have to make it that formal, but you always have to have someone who's taking a step back and seeing the forest for the trees. And I guess to me, that's sort of the similar question, which is, the only other hedge we had was that the incumbent technology would continue to survive long enough that if these technologies ended up not being able to do the job, that we'd have time to scramble and find something else. And the slides, what I didn't mention here is we tried so hard to avoid the web. We were a Windows shop through and through. Our legacy platform is Windows, MFC, all through. There's some .NET in there, but it's almost all Windows, MFC. No one knew how to program to the web. We knew chances are if we were going to really embrace AWS as we wanted to, we're going to have to move to a Linux development environment on the back end. No one knew how to do any of that. And so we were looking at Citrix. We were looking at kind of the true thin client, where we wanted to get out of the business of having to manage 40 different deployed versions of client software. So what better way than to use Citrix? Has anyone here ever heard of OnLive? It's that old video game streaming system where you weren't actually playing the video game locally, you were just streaming it. Microsoft is actually launching a version of that coming up. But basically, the true definition of a thin client, where we could still run a Windows GUI, but we just wouldn't run it on the client's machine. We would just run like a thin client stream of it. We tried really, really hard to avoid the web, mainly because it was so different to us. But we knew that was the future. This was right around the same time. Maybe this is getting a little too nerdy here, but this is right around the same time that Windows was moving away from WinForms. It was clear that their bet in WPF as the next generation way to build Windows apps was failing miserably, and no one really knew what was going to happen. And to us, that was evidence that the web was kind of the future that everything was going to be built in. But no, we didn't really have a plan B.
We actually have two microphones on
Okay.
this side and on that side, so, and we're recording the
And I'll
talk, so-
repeat the questions if we don't have the mic.
Okay, so please wait for the mic.
Any other questions? Nope, there you go. It's a race.
What incentive do large companies or huge companies like Google have to keep innovating if they can just buy or purchase access to technologies that are more innovative, or smaller companies that are more innovative?
Well, I mean, if they always knew and believed that they had the financial capacity and right of first refusal to buy any technology, maybe they wouldn't care so much. But that's not always the case. I think if Google tried to buy Uber right now, I know they tried years ago, but if they tried to buy them now, they probably couldn't. I think, look, Google has tried to institutionalize this process by really sort of bringing their corporate company up a layer and saying we're going to create standalone companies that are us placing bets elsewhere, whether it's autonomous, Waymo, autonomous cars, or any of the other businesses that they have that are essentially failing. They've sort of tried to institutionalize this at global corporate scale. But I think you need to be careful that you can't assume that you can always buy the thing that you want to become. And look, I mean, integrations like that, especially at big companies like that, and Google's like, what, 80,000 employees now, maybe even more than that. Integrations don't always go as well as something sort of coming organically within a business, and I'm sure that's a big part of it as well. Question back in the middle.
As your company and product really evolved through the years, how much time and effort really were you spending to educate some of your larger customers from a regulatory compliance, a penetration testing, all of those things that would have allowed them to say, hey, you know what, we're going to take a yo with this emerging technology, especially given some of the unknowns that you were, betting on?
So that's a really good question, because, and it's an insightful question, because the lesson we learned, like the biggest lesson we learned throughout this process was it's really hard to compete with TT, and we were essentially trying to compete with ourselves. And it's hard to compete with us, and we took comfort out of this, not just because I think the technology that we've built over 20 years is great, but also because the hoops you have to jump through now to be a vendor of record within a global tier 1 bank from a security standpoint, from a penetration test standpoint, those bars have raised so much. And we've been in these banks for 20 years now, and those bars weren't there back then. And you're sort of grandfathered in. Now that we're realizing the reality of, hey, Goldman Sachs, we've got a platform that uses the cloud. Do you want to use this platform? Well, we spent literally 24 months going through with some of these banks, showing them how we do secure key management within AWS. Part of it was education to your question about the fact that, no, AWS can actually manage a data center far more securely than you can, tier 1 bank. I think a lot of them had to get over that idea that, well, we've got our own employees who we trust literally manning the ship with our data centers. They had to get comfortable with the fact that Google and Amazon can do this better and far more securely. But it's been a long process, but we actually take a lot of comfort in the fact that throughout this period where not only were we educating the industry on, no, these technologies are not just safe, they are safer, and they are commercially very compelling to you. We've had over this 5.5-year period, we've had a lot of opportunity to make the investment in getting in the security good graces of these tier 1 banks that we know are competitors. Even if we thought all those technological challenges a competitor could do in a month, they have years of going through all of the security review process that we've had to go through, given this new frontier of technology that the banks are still, I think, coming to grips with. In a lot of ways, I think we were pioneers, and that didn't do us any favors because a lot of the paths that we had to go through, banks these days probably have their own AWS best practice list that they'll just give to a vendor and say, we need to make sure you're following this list, and if you're following this list, then you're good. They didn't have that when we were coming through with them. We were kind of both learning at the same time. But I think we really do have an advantage given that head start. Any other questions?
I have a question. Yes. So I'm curious, as an organizational psychologist, what is the decision-making process that goes into the making of these bets? So how do you make these decisions? How much conflict is there? How much disagreement is there on what you're going to be betting on?
That's a good question. I wish I had a really thoughtful, insightful answer for that. But when I came back to TT in 2012 to kind of fix this, we didn't know what the heck we were doing. We knew here are the things that we would be really, really afraid of if someone else was doing. And this is probably the answer to most questions about how do you best do something in business. Surrounding yourself with a management team that's diverse and that you trust and where there's sort of mutual trust. Yes, there's conflict. There's differences of opinion whether one technology will sort of win out over another. But the best decision, hands down, the best thing I've done at TT in my 7 years now is really surrounding myself with people that have formed a lot of trust and who bring their own views to the table for these types of discussions. But trust me, it's challenging, and it's not even just big bets like this, even small product decisions. We have the biggest industry event in our industry happens next week in Chicago, and we're going to market. We're announcing to the world for the first time a new product, and I had to shut my Slack tab off before I started this because there's a heated debate happening right now as to what our brochures are going to say and show. But I mean that's the fun of it, and if you surround yourself with people that at the very least can say I disagree, but I understand the reasoning behind it, that's half the battle.
So we have one question.
Thanks so much for coming here and sharing your wisdom. I have a quick couple of questions.
Sure.
You mentioned earlier about can you just talk about the future of as you see it, but also there's a certain level of ingenuity of what you're observing, right? At that very same time, there was a host of regulations that came out that dynamically affected the market, right? So a lot of big banks became like regular banks, and they focused primarily on retail. Markets became dramatically ossified. Now, there used to be 20 companies. Now there's maybe one or two that represent what used to be 20. So could you kind of delve in a little bit more into how do you guys internally filter what you think you saw and what actually is, and then talk about where you see growth-wise as there's been an encumbered 10-year growth rate. Are you guys worried that there's going to be some collapse of some sort in many markets because some people feel there are a lot of bubbles there?
Yeah, good questions. I'll remind me if I miss one of those questions. But you asked what my thought on the future is. Do you mean like flying cars, like in general, or do you mean with it? No, I'm joking. I do think we'll have flying cars at some point. So the regulatory hurdles are a challenge for us and for anyone in our industry. The biggest reason they're a problem is because the regulators themselves don't do a great job defining how to implement or what some of the regulations mean. And so what that means is you've got 10 tier 1 banks as clients. You probably have 10 different interpretations of what, MiFID. MiFID is a European regulation that just went live this January. There are 10 different interpretations for what technology needs to do to be MiFID compliant. The good news from our perspective is most of these things have been around ways of managing data. And that's kind of my answer to all of your questions, which is a lot of the regulatory things that have been impactful to futures commission merchants, so the ones who are actually providing futures clearing in our industry, have been around data retention. I could spend days talking about some of the data platforms that underpin this new generation technology that we've built, but basically taking something that 5 years ago was a burden on any trading firm or any bank or broker, the requirement to keep data around for 7 years. So 10 years ago, that wasn't a problem, because if you're let's say you're trading pork belly futures, you might do 50 trades on a busy day. Well, now 10 years later, you're a busy pork belly futures trader, you do 25 million transactions, because it's not you doing them, it's 20 of your algos that are doing these orders. Well, those regulations didn't sort of evolve as the industry evolved. So now this poor mom and pop broker has to keep your 25 million daily transactions backed up on tape for 7 years. Like, they'll fill a closet up in a month's time, and that's what they do. They just have like reams of boxes of tape, because if a regulator comes and says, "What's your name?" Kamal. So, we think we saw Kamal doing something strange June of 2017. On June 13th between 7 and 8 a.m. We want to see his transactions. Someone has to go, literally, this happens probably every day, has to go back and find the tape that has your trading activity on it for that time frame in question and give it to the regulator. So as you can imagine, like, these are problems that Google and Facebook and Amazon and everyone for that matter has been solving, data retention and storage and retrieval for years and years and years now. And so our approach was an agnostic one from a how are people going to care and use this data from a regulatory perspective. And so, for instance, now if that firm was using our new platform on the date in question, and a regulator said we want to see what he was doing on this hour time frame, 2 clicks, 5-6 seconds later, they've got a link to an S3 bucket that has just those transactions for just that trader available to them. And so our view and most of the regulatory challenges that the participants that we interface with have been around workflows like that. And we take the view of, if we can be open from how people consume the data that our platform generates, how they provide data to us, and what they do with that data, then we don't really have to get into the battle of interpreting or trusting the way our clients interpret regulation. So I think that the future, though, and where we see our ability to provide the most value going forward really is around data. And that's the most generic, overused statement in the world. But in our world, it's growing increasingly important for firms, even individual traders, to be able to take this data that used to be a massive burden to them and now use that to, for instance, apply machine learning to it and be able to find insight in your years of trading data that previously you had to retain at great cost. Now you can actually start to use that to generate alpha and generate new trade ideas. And that's where we sort of see the most value we can add is both bringing the level of access to this type of technology to where all you need is a browser, but then also taking that same level of access to potentially petabytes of data for an individual trader and letting them find real value out of that.
And that's all the time we have for today. Thank you very much for being here. Can we all give him a warm round of applause?
Thanks, everybody.